Welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Yeah, it's great to be here, isn't it?
Absolutely. So, we've been hearing a lot about this idea of a K-shaped recovery lately, where some parts of the economy, like luxury real estate, seem to be thriving while others, particularly affordable housing, struggle.
Right, it's a fascinating concept. It really highlights the divide in the market, and for us as investors, it raises some important questions.
Exactly. Today, we'll dive into how this recovery impacts real estate investing and what opportunities might be out there, whether you're looking at higher-end properties or more budget-friendly options.
And we'll also explore some practical strategies for building long-term wealth, no matter where you fall in that spectrum.
Plus, we'll share some real-life examples and tips that you can take away and start applying right away.
So let's jump in, shall we?
Yes! First off, Mike, can you explain a bit more about what this K-shaped recovery really means for someone considering investing in real estate?
Sure. So the K-shaped recovery essentially means that while some sectors are bouncing back, others are lagging behind. In real estate, you'll see luxury homes selling quickly, while affordable housing inventory remains tight.
That's so interesting. It really gives us a lot to think about.
So, Sarah, as we dive deeper into this whole K-shaped recovery thing, it's really crucial for folks over 40 to understand how it impacts their real estate decisions.
Absolutely, Mike. I mean, when you think about it, a lot of people in that age group are starting to think seriously about retirement, right?
Exactly, and that's not just about accumulating wealth anymore. It's about protecting what you've built, especially in this economic climate where inflation seems to be creeping up on us.
Right, and a lot of folks might feel a little anxious about how their investments will hold up against rising costs.
Totally. I had a client, let's call him John, who's in his late 50s. He was really worried about his retirement savings being eroded by inflation. So we sat down and looked at how putting some of that money into rental properties could actually serve as a hedge against inflation.
That makes sense. Real estate tends to appreciate over time, doesn't it?
Exactly. And the rental income can provide a steady cash flow that can also help keep pace with inflation. So John ended up buying a couple of affordable housing units, and he's really seeing the benefits now.
That's a great example. I think a lot of people underestimate the emotional side of financial security.
Yes, it's huge. When you have that peace of mind, knowing your investments are working for you, it really changes how you approach retirement. I mean, nobody wants to be in a position where they have to rely on family or friends for financial support later in life.
Exactly. And that's another thing. With the wealth transfer that's happening now from one generation to the next, people over 40 really need to consider how they can create a legacy for their families.
Right. Investing in real estate, especially in affordable housing, can be a way to do just that. It's not only about building your own wealth, but also providing something solid for your kids or grandkids.
Yeah, I know someone who inherited a couple of properties from their parents. They were able to sell one and use the proceeds to start their own investment journey.
That's a perfect example. And, it's about having options. The more assets you have, the more flexibility you have down the line.
And let's not forget how market shifts can impact these decisions. I mean, we're seeing luxury markets cooling off a bit, while affordable housing is still in demand.
Exactly. This is where that K-shaped recovery really comes into play. If you're focusing on properties that cater to essential needs, like affordable housing, you're likely to be in a better position during economic downturns.
Right. It's about resilience, isn't it? Like, folks over 40 should be looking for stability in their investments, especially with everything that's been happening in the economy.
Yes, and think about it. With more people entering the rental market due to affordability issues, there's a steady demand. That's why affordable housing can offer a more reliable return compared to luxury properties, which can fluctuate more with the economy.
And it's not just about the financial aspects. There's also a huge emotional component. Knowing that you're contributing to your community by providing affordable housing feels good.
Definitely, Sarah. It's fulfilling to know you're making a positive impact while also securing your own financial future.
It's a win-win, for sure. And then, of course, there's the aspect of timing. With people living longer, there's a need to think about longevity in your investments.
Right, and that means considering how properties will perform over the long term. It's not just about the immediate returns. It's about sustainability.
Absolutely. And I think that's where a lot of people get stuck. They're looking for quick wins rather than thinking about how their investments will fare decades down the line.
Exactly. I often tell my clients to think of real estate as a marathon, not a sprint. It's about building that long-term wealth, and with a K-shaped recovery, certain sectors are definitely more promising than others.
And that's why we're here, to help guide our listeners through these decisions. It's about being strategic and informed, especially now.
Yes, and when you start thinking about how you can leverage those market trends, it becomes clearer which properties are worth investing in.
Right, and with that in mind, we can delve into some core strategies that will help our listeners navigate this landscape effectively.
So when we talk about a K-shaped recovery, it's really important to think about how it impacts different segments of the housing market. You know, luxury properties might be thriving, while affordable housing is struggling, or vice versa.
Exactly, and that's where understanding your investment strategy becomes crucial. For someone looking to invest right now, I'd say start by figuring out which end of that K you want to focus on. Are you leaning more towards luxury markets or affordable housing?
Right, and if you're leaning towards affordable housing, a good rule of thumb to remember is the 1% rule. Basically, you want to aim for your monthly rent to equal at least 1% of the property purchase price. So if you buy a property for $200,000, you'd want to rent it for at least $2,000 a month.
That's a solid rule. But, it can be tricky in some markets. What if you're in a place where rents are lower? Say you buy a property for $250,000 and can only get $1,500 a month.
Good point. In that case, you might need to adjust your expectations or look for ways to increase your rental income. Maybe remodel the kitchen or add another bedroom to make it more desirable. You could also consider the 50% rule, which suggests that about 50% of your rental income will go towards operating expenses.
Ah, right. So if you're collecting $1,500 a month, you'd set aside $750 for expenses. That gives you a clearer picture of your cash flow, doesn't it?
Exactly. And when you're looking at cash flow, you'll want to consider your financing options too. Are you planning to buy outright, or are you considering a mortgage?
Well, if you're financing, you've got to factor in your mortgage payments, right? That's where understanding your cap rate comes into play.
Yes. The cap rate is a great tool for evaluating the potential return on an investment. It's calculated by dividing the property's net operating income by its purchase price. So if you have a property generating $12,000 a year in net income and you bought it for $200,000, your cap rate would be 6%.
That's a pretty solid cap rate. Generally, anything above 8% is considered a good investment. But I imagine, like most things in real estate, it varies by location and market conditions.
Absolutely, and you really want to do your homework on the local market. A good checklist for evaluating a property could include things like location, condition, nearby amenities, and the vacancy rate in that area.
And don't forget about the potential for appreciation. If you're in a market that's on the rise, that could really enhance your investment over time.
Right, and speaking of appreciation, it's important to look at historical data too. For example, if you're considering a neighborhood, check how property values have changed in the last 5 to 10 years.
That's a smart move. And what about property types? Should someone just starting out focus on single-family homes, or is it worth looking at multifamily units?
It really depends on your comfort level and what you're looking for. Single-family homes can be easier to manage, but multifamily units often provide better cash flow potential. If you buy a duplex, for example, you can live in one side and rent out the other, which helps offset your mortgage.
That's a great strategy for first-time investors. Plus, it gives you that extra layer of security. If one tenant moves out, you still have income coming in from the other side.
Exactly, and you can also scale up from there. Once you get comfortable with a duplex, moving to a fourplex or a small apartment building might be the next step.
And I imagine being in a position to identify good deals is key. What's your advice on deal evaluation?
I'd suggest having a solid deal evaluation checklist. Start with determining the property's cash flow. Look at the cap rate and factor in your financing. Then, assess the condition of the property and estimate any repair costs.
And let's not forget about the importance of doing a neighborhood analysis. You want to know about schools, crime rates, and future development plans in the area?
Absolutely. Also, don't overlook the importance of networking. Talking to local real estate agents, property managers, and other investors can give you insights you won't find online.
Right. And those connections can sometimes lead you to off-market deals, which could be a real game changer.
For sure. But it's also important to stay aware of potential pitfalls. I mean, it's easy to get caught up in the excitement of a deal, but you've got to stay grounded.
Like making sure you don't over-leverage yourself, right? It's tempting to go all in, especially if you see others doing well, but that can put you in a tough spot if the market shifts.
Exactly. And also, don't underestimate the importance of having a cash reserve. Unexpected expenses can crop up, and if you don't have a financial buffer, it could really hurt your investment.
So true. And remember, it's okay to walk away from a deal if it doesn't feel right. There will always be other opportunities.
Yep. And always trust your instincts. If something feels off, it probably is.
That's great advice, Mike. Let's dive deeper into those common pitfalls next.
You know, Sarah, one of the biggest pitfalls I see investors falling into is over-leveraging. They get so excited about a property, they think, oh, I can stretch my budget just a little bit more. And before they know it, they're in way over their heads.
Yeah, I can see how that happens. It's easy to get caught up in the excitement of a great deal, right? But then, if the market shifts or something unexpected comes up, it can really put them in a tight spot.
Exactly. I remember a client of mine, let's call him Tom. He found this gorgeous property in a trendy area. He was convinced it was going to appreciate, so he took out a huge mortgage, thinking he could flip it in a year. But then, the market cooled off, and Tom was stuck with high payments and mounting costs.
Ouch, that's tough. So what could he have done differently?
Well, for starters, he should have looked at his cash flow more closely. I mean, it's critical to ensure that the income from the property can cover all expenses, not just the mortgage. If you're relying solely on appreciation, you're taking a big risk.
Right, so understanding cash flow is key. What are some signs that cash flow is going to be an issue?
Good question. If the property's rent is significantly lower than the mortgage payment, that's a huge red flag. Or if it requires extensive repairs that you didn't factor into your budget. You really have to dig into the numbers and be realistic about what you'll earn versus what you'll spend.
That makes sense. And I guess bad tenants can also complicate cash flow, huh?
Absolutely. I've seen investors get into trouble because they didn't properly vet their tenants. I had another client, let's call her Lisa, who was in such a hurry to fill her rental that she skipped the background check. Turns out, the tenant had a history of late payments and damage to previous properties.
That's a nightmare. What happened with Lisa's situation?
Well, she ended up with multiple late payments, and eventually, the tenant caused damage that cost thousands to repair. It was a costly lesson. The best thing investors can do is take the time to screen tenants thoroughly. Checking references, credit history, and even meeting them in person can make a huge difference.
So it sounds like investing in good tenants is just as important as the property itself.
Exactly. And speaking of properties, another common mistake is ignoring hidden costs. Many investors focus only on the purchase price and forget about the ongoing expenses. Things like property taxes, insurance, maintenance, and even HOA fees can add up quickly.
Yeah, those can be real surprises, can't they? I mean, if you're not prepared for those costs, it could eat into your profits.
Totally. I had a friend who bought a property thinking it was a steal, but once he got into it, he realized the roof needed replacing and the plumbing was a disaster. He didn't factor those repairs into his budget, and it turned into a money pit.
Wow, that's a tough lesson. What advice would you give to someone so they don't fall into that trap?
Always do a thorough inspection before purchasing. Hire professionals if necessary and budget for repairs. A good rule of thumb is to set aside around 1% of the property's value each year for maintenance and unexpected costs. It's better to be safe than sorry.
That's great advice. And what about timing the market? I know that can be a tricky game.
Oh, for sure. Many investors think they can time the market perfectly, but that's really a gamble. I had a client, Dave, who waited for what he thought was the, quote, perfect moment to buy, but then prices shot up, and he missed out on some great opportunities.
So what should people focus on instead of trying to time the market?
Focus on your long-term strategy. Look for properties that align with your goals rather than trying to chase trends. If you find a solid investment, it's often better to buy it and hold on to it than to wait for that perfect moment that may never come.
That's a great perspective. It sounds like having a clear strategy can really help in avoiding those pitfalls.
Exactly. And remember, if you do make a mistake, it's not the end of the world. Learn from it, adjust your strategy, and move forward.
Definitely. It's all part of the learning process, right?
Absolutely. And keep an eye out for red flags. If something seems too good to be true, it probably is. Be cautious about properties that are priced significantly below market value. Often, there's a reason for that.
So it's important to do your homework and trust your instincts.
Yes, trust but verify. And don't hesitate to walk away from a deal if it doesn't feel right. There are always other opportunities out there.
And if someone finds themselves in a tough spot, what are some next steps they can take to recover?
First, assess the situation honestly. Is it a cash flow issue? Bad tenants? Whatever it is, pinpoint the problem. Then, consider consulting with a real estate advisor or mentor who can provide guidance on how to navigate out of it.
That sounds smart. Getting a second opinion can really help clarify things.
Exactly. And if you're struggling with cash flow, look at ways to increase your rental income. Maybe consider short-term rentals or renovating to add value.
Those are great ideas. And I guess it's all about being proactive, right?
Absolutely. The more proactive you are, the better prepared you'll be to handle challenges as they come.
Great advice, Mike. I think this gives our listeners a lot to think about as they navigate their real estate journeys.
For sure. And remember, every investor faces challenges. What's important is how you respond to them and learn along the way.
Well said. Let's move on to some actionable steps our listeners can take to implement these lessons.
You know, Sarah, when we talk about actionable steps, it's really all about breaking things down into manageable pieces.
Absolutely, Mike. It can feel overwhelming, but starting small is key. What's the first thing you'd suggest someone do if they're looking to take advantage of this K-shaped recovery?
Well, one of the simplest things you can do is to get familiar with your local market. I'd recommend using apps like Zillow or Realtor.com to start. They're great for browsing properties and getting a sense of what's available.
Right, and you can filter by price, location, and even property type, which is super useful.
Exactly, and once you find something that catches your eye, it's a good idea to check out rental prices in the area. That's where Rentometer comes in handy. You can see what similar properties are renting for, which helps you gauge the potential cash flow.
Oh, that's a great tool. It's all about understanding the numbers, right?
Exactly. And if you want to dive deeper into analyzing deals, you might want to check out tools like the BiggerPockets Calculator or Deal Check. They let you input your numbers and help you see if a deal makes sense financially.
Those calculators are lifesavers. And speaking of numbers, developing a habit of analyzing at least one deal a week can really help you get into the groove.
Yes! Consistency is key. It doesn't have to be a huge commitment. Just set aside a little time each week to look at a different property, run the numbers, and learn from each analysis.
And while you're at it, joining a local real estate meetup can be so beneficial. It's a great way to network, share experiences, and learn from others in your community.
Absolutely. Connecting with people who are on a similar journey can provide you with insights and support that are invaluable. Plus, hearing real-life experiences can motivate you to take action.
You know, there are also some fantastic books and podcasts out there that can help deepen your understanding. What's one book you'd recommend?
I'd say the book on rental property investing by Brandon Turner is a must-read. It covers everything from finding good deals to managing properties.
Great choice. And for podcasts, BiggerPockets Podcast is fantastic. They interview investors at all levels so you can hear a variety of perspectives and strategies.
Yeah, and it's nice to listen while you're doing something else like driving or exercising. You can absorb a lot of information passively that way.
For sure. And let's not forget about the importance of setting financial goals. Even if they're small at first, having a clear target can keep you motivated.
Definitely. Start with a specific goal, like saving for your first investment or learning about a new market. And remember, it's okay to adjust those goals as you learn more.
Speaking of learning, utilizing local MLS access can provide you with a wealth of information about market trends and property histories. It's like having a treasure chest of data at your fingertips.
Exactly. And if you're not familiar with how to use MLS, There are often classes or online tutorials that can help you get started. It's worth the investment in time.
And don't forget to track your progress. Maybe keep a journal or a spreadsheet where you log the deals you analyze, the books you read, and the connections you make. It's a great way to see how far you've come.
That's a solid idea. Celebrating small wins is important to maintain motivation. It can be as simple as recognizing when you've made a new connection or learned something new.
And let's remind listeners that it's okay to start where you are. You don't need a ton of experience or capital to begin. Just take those initial steps.
Exactly. Every investor, no matter how successful, started somewhere. So take a deep breath, commit to learning, and begin taking action.
With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
Well, Sarah, it's been quite the conversation today, hasn't it?
Absolutely, Mike. I mean, the whole idea of the K-shaped recovery really gives us a lot to think about, especially how it affects different segments of the housing market.
Right? So if we summarize a few key takeaways, one big point is that luxury housing is booming, while affordable options are still struggling to keep up. It really highlights how different parts of the market are responding to the current economic climate.
Yeah, and another thing we touched on was the importance of understanding your target demographic. Investors need to know who they're catering to, whether it's high-end buyers or those looking for affordable housing. It really shapes your strategy.
Exactly, and let's not forget about the potential for long-term appreciation in both segments. Investing in the right area can really pay off, regardless of whether you're targeting luxury or affordable housing.
And we also discussed how essential it is to stay informed about market trends. I mean, keeping up with economic indicators can help you pivot your strategy when necessary.
For sure, being adaptable is key. So as we wrap up this episode, I just want to encourage everyone to take those steps toward building wealth through real estate. It's an exciting journey, and every step counts.
Absolutely. If you found value in our discussion, please like, subscribe, and share this episode with someone over 40 who might be interested in investing in property. And don't forget to drop a comment about your biggest takeaway or any questions you might have.
Next time, we'll dive into student housing investing post-pandemic. It's going to be an interesting topic, especially with the shifts we've seen in that market.
I can't wait. Thanks for joining us today, everyone.
Yeah, thank you all for listening. Take care and happy investing.
Until next time.